I decided to do something pretty fun today and go over a screener where I look for stocks trading below 10 times earnings. This is just finviz.com. Most of you are familiar with the website. They have a pretty cool screener. You could just search for stocks just trading below 10 times earnings. So I looked for them and I found three interesting stocks that have some kind of potential trading below 10 times earnings. I normally love doing such research. It excites me whenever I try to look for a bargain. Although a lot of them could end up being value traps and they can go down another 30 or 50%. It did happen many times with my stocks or maybe with some of your stocks that maybe you looked into. So I'm going to look at three stocks that I don't talk about often. I mean, this is not the stocks I talk about in my two undervalued stocks. It's something a little bit different. So I'm going to look into three of those stocks, try to determine if they have some kind of potential trading below 10 times earnings, if it's an opportunity or if it's a value trap. If you enjoy that stuff, I can look at them every single month and maybe just find three different stocks. Maybe like Ford Motors is trading below 10 times earnings, but I haven't looked at it in the video. Maybe I could do something like that next month. It's going to be a pretty quick review and I'm going to try to keep it within the 10-minute range so it's not a deep analysis or anything. All right. Now, the first stock that's trading below 10 times earnings, and I found it pretty interesting, is actually Pfizer stock, ticker symbol PFE. It's now sitting at $32 per share. This was another massive COVID beneficiary. It set around $61 per share and now sitting at $32, the same price it was trading at in 2015 or 2016. I mean, pretty bad sentiment around Pfizer. But if this is the trick with Pfizer, that if you look at the PE ratio, it's sitting at 8.5 times earnings. This is very low, but it's very deceiving to a lot of investors because Pfizer is not sitting at 8.5 times earnings. Pfizer is actually sitting at 11 times earnings, but this is forward earnings. And 11 times forward earnings would put it at the mean multiple of 11.5 times. Now, the main reason the forward PE is much higher than the trailing PE is because, again, the COVID benefit stuff in 2022, so net income was massive, around $37 billion, and now it's going to drop back to $18 billion, and it's expected to be pretty much flat for the next 3 to 4 years, which is why it's trading at 8.5 times earnings on the screener. You could look at it in terms of 2022 numbers, but 2023 numbers, which is what matters, is trading around 11 times earnings. So with Pfizer trading, around 11 times earnings, there's a lot of uncertainty around the company, but especially their acquisition of Seagen. The market believes that, Pfizer overpaid for Seagen. Seagen is still an unprofitable company. It's not going to be profitable before, 2025 and no meaningful profitability before 2027. This is if they even hit the numbers. Now, I'm not sure if Pfizer has some kind of synergies or something they can do, but there's a lot of bad sentiment. So Pfizer is now trading, as I talked about, 11 times, which is the mean multiple. Normally, I don't like to buy those stocks at the mean multiple. I try to leave room for a potential multiple expansion so I can get a higher return. So assuming Pfizer stays the same multiple over the next few years, and assuming the analysts are right in terms of the net income of Pfizer being pretty much flat to slightly up over the next few years, so everything is flat, the only thing I can use to determine a return is something like the free cash flow yield. And if I look at the forward free cash flow yield of Pfizer, it's pretty close to 9%. So I would expect something like a 9% return every single year in terms of buybacks and dividends. If they use 100% of the free cash flow to return it to shareholders, I would expect 9% every single year. I would personally like to buy Pfizer a little bit lower so I can get some kind of a multiple expansion. Like if it trades at something like 9 times forward earnings, I can say, all right, I'm getting 9% a year, and I can get a multiple expansion back to 11.5. This would give me 13 to 14%. So it would be much more interesting. Pfizer is trading below 10 times earnings. It's not bad at this price, but I think we can find better opportunities in the market. Now, another stock that came up on the screener that's trading below 10 times earnings, it's one of my favorites. I talked about it before, and this is Crocs, ticker symbol CROX. And Crocs is trading now at $82. It's pretty close to the support from March 2020. A lot of you are technical analysts, so I'm trying to include some of it in my videos. It's getting pretty close. It could maybe held it around $69 or $70. So from a technical standpoint, Crocs is starting to get pretty interesting, but from a valuation standpoint, it's much more interesting than you could ever imagine. I have a deeper dive on the company, but now Crocs is sitting at 6.5 times earnings. I mean, 6.5 times earnings. It's just, it's been absolutely crazy. And the company is not declining in revenue, it's actually growing, especially in Asia Pacific. Crocs, shoes, and stuff, they are pretty popular in Asia Pacific. It's pretty insane. It has been growing at a 30% CAGR from fiscal year 2020 in terms of Asia Pacific. So this is not a company that's trading at 6.5 times earnings, but it's declining 20%. It's still growing in revenues. And if you look at the guidance, if you look at the EPS guidance, they ended up increasing the EPS guidance. So this is not a company that's revising EPS lower, it's increasing EPS guidance. It was 1117 to 1173, now it's 1183 to 1222. So they did increase guidance, pretty amazing. But this is what the market is worried about. This is why originally Crocs pretty much crashed in 2022. And I talked about it and it went up like 120% after we made the video on Crocs. The main reason the market was worried back then, and it's worried right now, it's because of the Hey Dude brand. Most of you are familiar with the Hey Dude shoes. They got pretty popular on Amazon and Instagram influencers and TikTok influencers wearing them. A lot of young people, they love the Hey Dude shoes. But the market was worried then that Crocs overpaid for Hey Dude. So this is why it was just, the stock was going down. And I believe the market is worried again. Because if you look at the, actually at the current earnings report, it's not the best growth numbers at all for Hey Dude. But if you look at the guidance of, Crocs, they did decrease the guidance for Hey Dude. It was around 20%. Now it's between 14% to 18%. So the guidance is a little bit lower than expected. And the market maybe is worried that Hey Dude was just a one-off kind of trend, and then people are gonna stop buying Hey Dude shoes, they're gonna love something else. So it has no brand loyalty, no mold. It's not like Crocs. And every single year people say Crocs is dead, no one wants Crocs anymore. Yet Crocs keeps increasing revenues, the brand keeps getting more and more popular. It's pretty crazy, but this is what Crocs is. But Hey Dude might not be the same. Maybe they just overpaid billions of dollars for a one-off, one-time kind of trend. And maybe the trend is fading away and then people are gonna buy a different kind of shoes. This is a very good argument. It's something that's hard to judge right now. This is something that is gonna require time for us to be able to make a conclusion if, Hey Dude was just a one-off or if Crocs did something with it. And the company took on a lot of debt to acquire Hey Dude, from 700 million to 2.8 billion, and they have been quickly deleveraging. I believe they're gonna get to 1 billion of that by the end of next year or the year after. I believe this is their goal. I have to look back at the statement, but I believe even with the whole uncertainty with Hey Dude, around $82 per share at 6.5 times earnings for a company that's increasing EPS guidance and it's still growing with declining inventories, I think Crocs is extremely undervalued here. I'm not sure if it's gonna hold the support around $69 or $70. I believe it will. It's just, it's been extremely beat up. And I think the company is one of the best ones that's trading below 10 times earnings. I think it's extremely, extremely undervalued. Now, another stock that surprisingly came up on the screener, trading below 10 times earnings, and I was surprised why it came on the screener. So I'm going to do a quick review on it, and it's actually PayPal. I did many videos on PayPal. This is another disaster stock. It topped around $300 per share. Now it's sitting at $55.75. I was always bearish on the company. Once it got close to $61, I started getting a little bit bullish. I sold some put options. I shared it in my previous videos. I've been selling puts, collecting good premium from time to time on PayPal. But PayPal did come up on the screener, and I was surprised. And I looked at it, it's actually right at 10 times earnings. It's 10.5 times earnings. But this is another one that deceives a lot of investors. A lot of investors look at PayPal and say, oh, we're trading at 10 times earnings. PayPal is dirt cheap. Well, yes, maybe you're right. But if you have to look at, also GAAP EPS, because there's a massive difference between GAAP EPS and non-GAAP EPS with PayPal, a lot of tech companies, because of the stock-based compensation. So using normalized EPS, which is the white one, at $4.95, PayPal is trading at 10.5 times earnings. This is dirt cheap. But if you use the $3.49 per share, which is the GAAP EPS, PayPal is trading around 17 times earnings. And I personally believe 17 times earnings is still extremely undervalued for PayPal, but there's a lot of uncertainty with PayPal. They recently got a new CEO, Alex Chriss, from Intuit, which is, I'm pretty optimistic about the CEO, but there's a lot of uncertainty. The market doesn't know what kind of plans the CEO has. Yes, he's been here for a few weeks or maybe a month right now, but what matters with PayPal is the first earnings call. This is the first, pretty much the only chance the new CEO can give investors an impression and can pretty much, tell them why they should be buying PayPal. Why should investors change their mind around PayPal? So this is going to be key for PayPal. The next earnings call is getting there pretty soon. And this was my opinion on, 3 stocks to consider trading below 10 times earnings. If you guys found it fun, if you enjoyed it, it was not financial advice. But if you did enjoy it, let me know. Maybe I could do one of those, review 3 different stocks every single month, trading below 10 times earnings. So thank you for watching it. If you did, please press the like button. Maybe consider subscribing. So I hope to see you in another video.